I think what we learned this morning was just, continuing strength in the labour market. As you pointed out, the unemployment rate now is at 3.8, which is back to where it was before the pandemic. That's actually lower than where we think the natural run rate is for the unemployment rate. Wages, yes, there is some issue with them keeping up with inflation, but in terms of nominal wage growth, it's very strong. It's coming close to 6%, whereas the trend in the UK before the pandemic was about 3%. And also, as you highlight, the vacancies hit another record high. Yes, the growth rate is decelerating a little bit, but there's still a lot of open jobs out there. So I think we've learned that the fallout from the end of the furlough scheme last September has been fairly smooth. There was a lot of concerns back then that there might be some disruptions, and we just haven't seen that in the data. So the UK labour market is looking very strong.
Just quickly, would you then count this as a success for the government's management of the furlough scheme and the general COVID recovery, or is it just a case of recovery from the pandemic?
I think what we've learned is that it was a very strong recovery from the pandemic, and we even had a fairly strong rebound post the Omicron wave. The data for the GDP growth data for January showed a very, very large spike up in that month. So I think we've seen that people are ready to go out and spend as the restrictions were lifted. Of course, all this data is, doesn't factor in any impact from the war in Ukraine. We're talking about February or early March data, so the war in Ukraine isn't factored into these data yet.
Now, in terms of the impact all of this is having on the markets at the moment, fixed income front and centre, stateside, Europe and here in the UK, you've got British government bond yields. Those gilts on the UK 20, it's hitting its highest since the day of the Brexit referendum. This coming across the wires now. That, of course, was in June 2016. It's at 2.105%, up 5 basis points on the day. Just how much higher could these yields go?
Well, it obviously depends what we think is going to happen with the Bank of England. And given this tight labour market and the building inflationary pressures, we think the bank is going to hike a few more times this year. We have a total of 6 hikes built into 2020. There is a lot of uncertainty as to where inflation is going to end up at the end of the year. We have the price cap, the household domestic energy price cap that will come in next October. We don't know quite what that's going to be yet. We've penciled in 35%, so an additional 35% increase. That's on top of the 54% that we're all just feeling this month. It's come through in April. So we think, given these pressures and the strong nominal wage growth, that the bank is going to continue to hike in back-to-back meetings through August. That takes bank rate to 1.5% in August in our projection. And then we have 2 more hikes. We think they'll slow a little bit after they hit that 1.5%. We have another hike in November, and then we get to 2% in May of next year. So we do see significant room for bank rate to increase